Hey everyone, this is Slow Burn Investor, and I'm just going to give an end of the year update for 2024. I'm just an average 9 to 5 worker with the dream of achieving my financial goals one day at a time. So, a couple years ago, I ran up my account to a high six figures and then proceeded to lose a majority of it through sheer cockiness and essentially a gambling mentality. While the aim was pure, wanting to achieve financial freedom, as cliche as that may sound. If any of you are like me, feeling stuck in what feels like an endless, soul-crushing rut of work, day in and day out, you know how enticing the concept of quick money can be. But I'm no longer blinded by this, and I recognize the value in steady, consistent gains, hence the name of the channel. Um, so what works for me might not work for you, and that's all right. But as a 9 to 5 employee, I have found that the wheel strategy offers the best balance. So with cash secured puts, my benefits are twofold: earning premium and owning shares at a lower cost basis than the current price. But don't be fooled by other people saying that it's passive. No, you still need to do your own research and select the right strikes. Another danger is missed profits. If your cash secured puts never get assigned, you never benefit from the share appreciation. Nevertheless, this strategy works best for me because the worst case scenario is I own shares of a company that I strongly believe in, as opposed to just a meme stock with high premium. Therefore, during my work hours, I'm not scrambling to adjust my position if I don't have to. I sleep better at night, and the psychological factor plays a larger role than you might think. And some would argue, well, if you just held your money in an index fund, you would have made 26% on the year without having to do anything. And that's true, which is why, all of my retirement funds are in index funds, along with my other taxable account. But also, while 10% is the historic average, that means some years are up and some are down, which is totally okay. What I like about selling options with share appreciation is that I can strive to, earn consistent income every month. Plus, it's also fun and, it's rewarding to make money yourself as opposed to trading time for money working for someone else. So with this, whether you fail or succeed is entirely on you. So as you can see, Uh, I started this account back up in March of this year, 2024, with a $50,000 deposit. I know it says 61,000, but that was because I cashed out my inflation bonds and transferred 11,000 this December. However, for whatever reason, Robinhood shows the total deposits dating back to the beginning of the year, which honestly is a little confusing. I've tried many brokerages: Robinhood, Webull, Tasty Trade, Vanguard, Thinkorswim, and honestly, I like Robinhood the best, and it's the easiest to use for me, even though it's considered a beginner platform. But you shouldn't be swayed by anyone who says, real traders don't use Robinhood. Listen, you should use whatever clicks with you the most and ignore all the other noise. In my experience, Tasty Trade was like great, but the fees were not worth it, in my opinion. And I still experienced issues with outages and the fact that customer service was email instead of in-app support. So year to date, I'm up a little over 19,000, and the majority of it was earned using the $50,000 initial capital. The only two tickers I traded this year were Tesla and NVDA. Again, going back to the point of choosing legit companies only, owning 100 shares of either would let me sleep just fine at night, even if my entry price wasn't optimal. So moving forward, I'm hoping to document my trading journey through 2025. Before starting to trade with the 50K, my initial goal was to just beat the rate that my cash was sitting in the money market fund, and I think at that time it was around 5%. And after beating that, my goal was to beat the average historic return of 10%. Ultimately, I was able to beat the S&P 500 year-to-date return while only active for 9 months since March. Of course, this is probably attributable to the raging bull market we had, and whether we see a correction in 25 or not remains to be seen. So as you see, last week I opened a new batch of cash secured puts expiring in January 2025. And while I have been trading solely in NVIDIA since June, I have expanded to include two other tickers into 2025, Robinhood and Reddit. Now, I'm personally bullish on both companies. I use the products every day, and I generally want to own shares in both eventually. As you can see, I stagger my expiration dates so that I can open new trades every week. I usually do 21 to 30 DT or 3 to 4 weeks at around a zero point 0.3 delta, meaning there's a 30% chance of it expiring in the money and 70% chance of it expiring worthless. Again, if it expires in the money, it's fine. I own 100 shares now at a price I'm good with, and I still keep the premium I received when I initially opened the cash secured put. If the share price is above the strike I sold, the option expires worthless, my capital is released from collateral, and I can open a new cash secured put. So if I'm feeling really bullish, and I anticipate a move up at some point, I might sell a higher delta cash secured put, like a point 0.4, which means that there's a higher chance of me being assigned these shares. Um, the higher delta would also give me more premium, but my primary reason would be to increase the chances of being assigned because, I'm anticipating a run up in the shares and I want to benefit from the share appreciation. So, for instance, I think Jensen Huang, the CEO of NVDA, is participating in the Consumer Electronics Show, which is on January 7th, I believe, through the 10th, 2025, which might spark the run up to earnings in February. So I decided that in addition to the cash secured puts, I bought a leap option. I bought a $100 call expiring in August 15th, 2025, and rounded up my NVIDIA shares to 100 in order to benefit from any run up. So currently I own 100 shares at an average cost basis of $130.80. If I was solely in a cash secured put, sure, they would expire worthless, right? But I would lose any potential upside from share appreciation. Plus, now I can sell cover calls on my shares and the call, which you can see I have done so. So I sold one $150 call, cover call on December 23rd, expiring January 10th, 2025, for an average credit of 146. So working our way down the list, you can see that I opened one cash secured put on December 19th, expiring January 3rd, 2025, at the $35 strike price for an average credit of 99 cents, which means it's $99 since each contract is worth 100 shares. And right now, I am up $85 on the position, or a total of 85.86%. I also opened 4 cash secured puts on December 23rd, expiring January 17th, 2025, for an average credit of 124, also at the $35 strike price, and I am up a total of $232 or 46.77%. I opened one cash secured put. I sold it on December 23rd, expiring January 17th, 2025, at the $160 strike price for an average credit of 780. And right now I am up $252 or 32.31%. I sold another cash secured put on Reddit for an average credit of 680, expiring January 24th, 2025, so 1 week later, also at the $160 strike price. And I am up $32 or 4.71%. And lastly, I opened one $130 put on December 27th, expiring January 24th, 2025, for an average credit of 370, and so far I'm up $35 or 9.46%. This is a summary basically of all the trades that I entered. This is a sheet that I made, and it's essentially it helps me keep track of my open positions. So if I look here in column B is the ticker symbol, column C is the day that I opened the trade, column D is the date of expiration, column E is the strike price that I sold, column F is how many of them I did, column G is the credit I received, column H is the net debit I would have to pay if I closed or rolled the option. Column J is the net P&L, how much I'm expecting to receive if the option expired worthless. Column K is the capital required for opening the cash secured put. So if you look at, let's say, row 2, ticker hood, I sold one cash secured put at the 35 strike for 99 cents or $99. And to open that, I would need to have $3,500 in collateral. Column L shows a return on investment. Column M shows the spot price, which is the price that the ticker was trading at the time that I opened the trade. Column N is the percent out the money. So it's the percentage that the strike price is out of the money relative to the spot price. And column O is the delta that I sold, of the option that I sold. So if you can see, most of the, or all of the tickers that I sold, the deltas are roughly around 0.3. So 30% chance of expiring in the money, 70% chance of expiring out the money, which is roughly what I aim for. And you can see that right now, I have $62,500 in collateral being used for the cash grip puts. If all expires worthless, I stand to make $2,424.76. On my cover call sheet, I show that I have one NVDA cover call at $150 strike price, expiring January 10th, and I stand to make $145.97. And right now, the cost basis is $13,080. So the summary tab is just based on the two prior sheets that feed into this sheet. So you can see that these are the premiums that I'm expecting to make by the date of expiration. So if everything expires worthless, I stand to make $2,570.73 in options premium for a year-to-date return of 3.24. So my goal for moving into 2025 is essentially to continue what I've done in 2024 and try to first achieve the 10% historic average return for the S&P 500. And once I meet that, strive to make 5% over that. So 15% total. So let's say I end 2024 with 80,000. I'm hoping to make $12,000 in 2025 and have an ending net account balance of 92,000. So we'll see how we do heading into the new year. Thanks.